Hey folks, Sean Plummer, founder and CEO of the Annuity Expert. In today's video, we're going to answer the question, are annuities taxable? One of the most popular questions we get on a daily basis is, are annuities taxable? How are they taxed? Which ones are tax-free? How can I avoid taxes? How can I reduce my tax bill? So today we're going to kind of go over the basics of annuity taxation. First question that we get, most popular one is, are annuities taxable? The answer is, it depends. Most annuities are subject to taxation on an ordinary income tax level. Any withdrawals or annuitized payments are going to be subject to ordinary income taxes, which is your federal tax bracket and your state income taxes. The way that they're taxed depends on how the annuity is funded. Annuities, in terms of taxation, are set into two categories, with one exception. There's qualified annuities, and then there's non-qualified annuities. A qualified annuity is an annuity that's funded with your qualified retirement account. Think 401k, 403b, IRA, thrift savings plan. All of those will be 100% subject to ordinary income taxes, whether that's through a penalty-free withdrawal, a lifetime withdrawal from an income rider, or an annuitized payout structure. The other type of annuity is a non-qualified annuity. And a non-qualified annuity is different in that it's funded with after-tax money. So any money that's funded with life insurance cash value or cash savings checking account, that's going to be considered a non-qualified annuity. And the money that's funding the annuity isn't going to be subject to taxes, but any interest earned along the way will be subject to federal and state income tax. The exception to the qualified and non-qualified annuity is the Roth IRA annuity. And with a Roth IRA annuity, it follows the same rules as the IRS, which is holding the Roth IRA for at least 5 years and not taking income from it to at least age 59 and a half. As long as you follow those rules, your withdrawals, your annuitized payment, your lifetime withdrawals, all tax-free. Now, getting back to the non-qualified annuities, those are taxed in two different ways, and not meaning to be complicated here, but I'm going to kind of go over this slowly with you, okay? So when you take money from an annuity, there's really two different ways that you can take money out of it. Number one is withdrawals. A withdrawal can be a penalty-free withdrawal that you take from the annuity, just like you're taking money out of a savings account or a checking account. And then there is annuitization. Annuitization is where you take all the money in the annuity and you convert it into an irrevocable stream of income. Basically, you're giving up control of all your money in the annuity to the insurance company in exchange for a guaranteed stream of income. These two methods are taxed differently. If you're taking a withdrawal, so a withdrawal meaning systematic withdrawals, like you're taking from a bank account, or taking lifetime withdrawals from a guaranteed lifetime withdrawal benefit or lifetime income rider, those are going to be subject to what's called a taxation method called LIFO, which stands for last in, first out. What that means in a nutshell is when you start withdrawing money from those annuities, from those non-qualified annuities, the interest is going to come out first. Any money you take out initially, it's going to be 100% taxable in most cases until you start eating into what you originally invested into the annuity. So to kind of give you an example of this, let's just say you have a $100,000 non-qualified annuity and it has grown to $150,000. And then you want to start taking lifetime income from this annuity. Well, what's going to happen is the insurance company is going to start distributing money and it's going to be reported to the IRS as interest being taken out first. So that first $50,000, assuming there's no gains or losses, it's going to be all 100% taxable as ordinary income. Once you start eating into that $50,000 and you're into that original $100,000 that you funded the annuity with, that's going to be all taxable until you hit that original investment amount. The second way is through annuitization, okay? Annuitization is a little bit different. How they're gonna tax those payments is they're gonna apply a ratio called an exclusion ratio. And basically what that is, they're going to take a portion of your annuitized payment that you receive is going to be taxable and another portion is going to be not taxable. So to give you an example, let's say you have a $100,000 annuity and $50,000 funded the annuity, it grew another $50,000, totaling $100,000. And then you decide, hey, I want to annuitize this contract. Well, that's 50% of that is money that's already been taxed, and the other 50% is subject to tax because it's interest that you have tax deferred up to that point. And so what will happen is you'll get your annuitized payment, let's just say for easy math, it's $1,000 a month. Well, of that $1,000 a month that you'll collect for the rest of your life, 500 of it will be subject to taxes and the other 500 won't. So it's a ratio of what's been funded with after-tax money, and the other portion is money that hasn't been taxed yet because it's been tax deferred up to that point. There are a few other types of annuities out there that aren't subject to annuities. They're not that popular. Charitable gift annuities. These annuities, you can go to a college or a educational institution, you give them money, and in exchange they'll give you tax-free payout. Don't typically recommend those because there's not as many guarantees and layers of protection in place, but that can also give you tax-free income as well. Just to recap what we went over, you got qualified annuities. Any withdrawals or annuitized payments are 100% subject to federal income tax and state income tax. If you have a non-qualified annuity, money that you've invested into the annuity is not subject to taxes, but any interest that you've earned is subject to ordinary income taxes. And then the Roth IRA annuity, which is all the withdrawals and annuitized payments are tax-free, as long as you follow the IRS rules. If you have any additional questions about how your annuity is taxed, or you have any tax questions about annuities, feel free to contact us at the Annuity Expert. Our financial advisors will answer any questions you have at no obligation. Hope you enjoyed this video, answered your questions. Like, subscribe, and we'll catch you on the next video.